If you don't find a way to make money while you sleep, you will work until you die. That's a quote by Warren Buffett, and it really drives home the point of the importance of what you're about to learn in this video. Dividends are the ultimate holy grail of passive income, aka making money while you sleep. I'm going to tell you exactly how stock dividends work and how you can get to the point of living 100% off of dividends. And we're going to get very, very exact with it too. Then I'm going to tell you why Berkshire Hathaway, Warren Buffett's company, has never paid a dividend, and why many of the best stock investments you could make also don't pay dividends. So by the end of this video, you're going to know exactly what's best for you. So let's get right into it. Hey, I'm Richard Hopkins and welcome to another video. If you're new here and you want to learn how to invest in stocks successfully and reach financial freedom sooner, then start now by hitting subscribe and ringing that bell so you don't miss anything. First, a quick recap of the fundamentals so that we're on the same page. When you buy shares of stock, you're buying a percentage of ownership in that company. All publicly traded companies have a defined number of shares outstanding, and if you own 1% of a company's shares outstanding, then you own 1% of that company. If you own 5% of a company's shares outstanding, then you own 5% of that company. So the hierarchy of it would look like this. We've got the shareholders, aka the owners, at the top. That's you. And then below them, we have the board of directors who are elected by the shareholders to represent their best interests. And then below the board of directors, we have the CEO, Chief Executive Officer. And the CEO is hired by the board of directors to run and manage the company. And the CEO reports to the board of directors. So if you're a shareholder, then the CEO is technically your employee. They're the person you've hired to run your company. A good CEO makes it their priority to maximize long-term value per share and then return as much value as possible to their shareholders. That return of value could be as dividends being distributed, or it could also be through growth in per share value. A CEO can also be a shareholder themselves, and when this is the case, it's actually a very good thing for you as a fellow shareholder, because it will help to ensure that they are in fact making decisions that are in the best interest of the shareholder, because they themselves are a shareholder as well. And a CEO has exactly 5 ways of using a company's profits in their efforts to return value to shareholders. And you can think of these 5 things as the 5 tools that they have in their toolbox. And they are 1, reinvesting in existing operations, 2, acquiring other businesses, 3, paying down debt, 4, buying back shares of its own stock, and finally, 5, issuing dividends. And obviously in this video, we're going to be focusing on dividends. Also, just a reminder, I'm not a financial advisor and I'm not your financial advisor. I'm just a guy on YouTube. So talk to a qualified professional before you make any investment decisions. All right, so if a company you own declares a 40-cent dividend and you own 100 shares, then you will receive $40 deposited into your investment account on the dividend payment date. Dividend-paying companies often pay out their dividends on a quarterly basis, so every 3 months. But some might pay semi-annually or some just annually. And then sometimes if a company doesn't regularly pay a dividend, they might decide to do a one-off special dividend. Also, there is no obligation for a company to pay a dividend, and if a company is already currently paying a dividend, there's no obligation or guarantee that that's going to continue. To get paid on the dividend payment date, you need to own the shares before what's called an ex-dividend date, which is usually just a few weeks before the dividend payment date. So when a company declares the dividend amount and date, they'll also tell you what the ex-dividend date is for that dividend payment. Here's a real-life example of a dividend stock, Coca-Cola. And if you Google Coca-Cola or any stock, you can see right here the dividend yield. Current dividend yield is calculated by taking the past 12 months worth of dividends and dividing that by the stock price. Coca-Cola has paid $1.62 in dividends over the past 12 months, so we divide that number by the current price per share of $51.04, which gives us 0.0317, which when expressed as a percentage is 3.17%. That's the current dividend yield. The reason why it shows as 3.21% here on Google is because this number is what's called the forward dividend yield, and the forward dividend yield is calculated by taking the most recent dividend payment and annualizing it, which would mean multiplying it by 4 in this case, since it's a quarterly dividend. So we would go 41 cents times 4 equals $1.64. And if we take that number and divide it by the price per share of $51.04, then we get 0.0321, which when expressed as a percentage is 3.21%, exactly what is shown here on Google. dividend yield will change as the price per share changes and when the dividend amount changes. As prices go up, dividend yield goes down, and as prices go down, dividend yield goes up. Forward dividend yield will help you to determine what you should expect to receive in dividends over the next year from your purchase of an investment right now. So if you purchase $100,000 worth of Coca-Cola stock, then you can expect to receive $3,210 in dividends over the next year. If you purchase $50,000 in Coca-Cola stock, then you can expect to receive $1,605 in dividends over the next year. And if you purchase just $300 worth of Coca-Cola stock, then you can expect to receive $9.63 in dividends over the next year. Let me tell you a story now. Warren Buffett, through Berkshire Hathaway, started buying shares of Coca-Cola back in 1988. They paid $1.299 billion in total for their shares, which means that today, Berkshire owns 400 million shares of Coca-Cola stock. And when Coca-Cola pays out that $1.64 per share in dividends over this next year, it will mean that Berkshire will receive $1.64 times their 400 million shares equals $656 million in dividends. And that's just in the next 12 months. Wow. This would mean that their dividend yield on cost would be 50.5%. That's 656 million divided by the original cost of 1.299 billion equals 50.5% yield on cost. Wow, a 50% yield on cost. That's insane. That's not even mentioning the fact that those 400 million shares are now worth over $20 billion. These are huge numbers we're talking about here, of course, but it would work the exact same way for you. If, for example, imagine that today you made a one-time investment of $10,000 to purchase the stock of a company that you think will do well over the long term. You buy it and you just hold on, and every year it returns an ever-increasing amount in dividends to you without any additional investment on your part, to the point that one day it pays you $5,000 in just one single year of owning that stock. And remember, this was from a one-time investment of $10,000 that you made without any reinvesting of your dividends or anything like that. Pretty wild, right? This is the power of owning a wonderful company and just holding on to it for the long term. And this is why I say that dividends are the ultimate holy grail of passive income, and it really doesn't get any more passive than that. Here's the next lesson. If you're gonna look at the dividend yield of a stock, you're also gonna wanna look at what's called the payout ratio. The payout ratio tells you how much of a company's earnings are being distributed as dividends. It's calculated by taking the dividends per share and dividing that by the earnings per share. So for Coca-Cola right now, the dividends per share have been $1.62 over the past year, and earnings per share over the past year have been $2.12. So you would divide the dividends per share by the earnings per share, which gives you 0.7642, or in other words, 76.42%. And this number tells you that 76.42% of the company's earnings are being distributed to the shareholders as dividends. And the other 23.58% of the earnings that are not being paid out to the shareholders as dividends, well, these are considered retained earnings. And with those retained earnings, the company could either simply put that money in the bank for later, or one, it could reinvest in its existing operations with the goal of making more money in the future. Two, it could buy other businesses, again, with the goal of making more money in the future. Three, it could pay down debt. Or four, you could buy back his own shares. Now, one of the things to keep an eye out for with the payout ratio is to make sure that the payout ratio isn't over 100%. Because if a company is paying out more in dividends than it's earning, then chances are it's not going to be able to sustain that dividend payment, and sooner or later that dividend will get cut. Ideally, some of your company's earnings are being retained so that it can use that money to grow and then in turn provide you with even more dividends each and every year after. All right, so here comes the part you've been waiting for. How much do you need to invest to get to the point of living 100% off of your dividends? Here's the simple way of doing the math, but I'm not gonna rip you off, so I'm also gonna show you a more complex way to get to that exact number that you're looking for. So here's the simple way. Let's say, for example, that the annual income you needed to live off of was $50,000 per year, and if you had that money flowing in passively from your dividends, you would not have to work at all. Well, if you were able to make an investment right now that had a dividend yield of 5%, then the math would simply be $50,000 divided by 5% equals $1 million. Investing $1 million right now in a stock that had a 5% dividend yield would pay you $50,000 over the next year, and ideally each subsequent year a little bit more. So if you were to win $1 million in the lottery, doing something like this might be a good idea. However, say you don't win the lottery and you're not just making a one-time investment, but rather you're going to be making regular contributions every month or every year. up until the point that you can retire and live 100% off your dividends. How long would it take and how much would you need to invest? Well, I wanted to be able to give you a very clear and exact answer, so I needed a way to account for a few variables. 1, your regular contributions. 2, the dividends being reinvested. 3, the actual dividend amounts themselves growing over time. And 4, your initial dividend yield. So I painstakingly made this pretty serious Excel sheet for you. So let's hop on the computer and I'm gonna show you right now. All right, so let's dive into it. Okay, so over here we've got I've just put $12,000 as the yearly additional contribution. So think of that as like $1,000 a month. So $12,000 you're gonna be adding every year. We have a dividend yield of 4%, and we're gonna say that the dividend grows at 5% per year. So in the first year, you'll invest $12,000, and 4% of that is $480, so it will return to you in dividends $480. So in the second year, you'll invest your $12,000 again, but you'll also invest that $480, which will provide you with $499.20, because that's 4% of this number here. Now, in the second year, your dividend has grown by 5%. So this year, it gives you $504. So in the second year combined, you get this plus this equals this, which gets added to your third year contribution, your $12,000 plus the $1,000 of dividends you've earned. Okay, so now let's fast forward a bit, and we're saying that, okay, we're investing $12,000, the dividend yields 4%, and the dividends are growing at 5% per year. So how long would it take to get to 50,000? So if we scroll down, around year 29 or 28 is when your stocks, your investments are paying you $54,000 per year in dividends. Okay, now this chart does not at all tell you what the total value of your stock portfolio is. It's only telling you what it's paying you in dividends per year based on these parameters. Okay, so on the 28th year, you're gonna be able to receive $54,000 in dividends. Now, what if we did, instead of $12,000 per year, you were able to put a little bit more of your money from your job towards it, so you do $24,000, double that. Well, in this case now, you'd actually be able to receive your $50,000 per year in dividends closer to year 20. Okay, and if you were gonna go crazy with it and you did $36,000 per year invested and you were earning a 4% dividend yield initially, and that dividend was growing at 5% per year, then by year approximately 16 or 17, you'd be earning $50,000 per year. Now, what happens if we were to get instead a 5% dividend yield? Okay, and maybe we're saying it's going to grow at 6% per year. Now, and we're still doing 36,000, just for example's sake, right? Well, then in this case, by year 13 or 14, you're going to be able to earn that 50,000 per year in dividends, purely from dividends. So let's say now that on year 14, you stop making any regular contributions. So we just chop all this out. This is gone. Boom. So after the 14th year, in the 15th year, you no longer contribute anything to your portfolio, your investments, because now you're just taking all those dividends and living off them. Well, so on the 15th year, you make 57,000, but it still continues to grow each subsequent year. And 30 years later, you're now making 137,000, and you didn't even invest anything after 15 years. On your 15th year, you'd stopped reinvesting and stopped making any contributions. So your dividend income will still continue to grow after you stop based on these parameters. But if we put that back, undo, and now we've got these numbers back, well, you can see that if you waited all 30 years to finally retire and you made contributions and reinvested your dividends all the way up until the 30-year point, eventually you'd be making $350,000 per year from your dividends. Okay, so one last thing. I am going to put a link in the description for a copy of this sheet, so if you want to play around with it yourself, you can. So bottom line, I'd say the short answer to how much you need to invest in order to live 100% off dividends is somewhere between $300,000 and $2 million. And it will depend a lot on how long you have your dividend yield and the dividend growth rate. Hey, it could even be much less than that still too, if you were to invest in a real wonderful company, right? Remember that Coca-Cola example from earlier in the video? Okay, so now you're gonna kinda hate me because I'm gonna throw a wrench into this whole plan of yours I know you got brewing up right now, but you're actually gonna love me. Well, some of you. Berkshire Hathaway, Warren Buffett's company, has never paid a dividend. And the reason for this is that he believes, and rightly so, that he can return more value to shareholders by not paying a dividend. Instead, retaining all earnings and using that money to reinvest within its own operations and and acquiring businesses, both wholly owned acquisitions and partial ownership acquisitions through buying shares of publicly traded stock, just like you and I can do. And when we look at Berkshire's latest annual report, we can see that this strategy has very much paid off for the shareholders of Berkshire. Compared to the S&P 500 with dividends included, Berkshire has achieved a 20.3% compounded annual gain since inception, compared to 10% compounded annual gain for the S&P 500. Or in other words, an overall gain of 2.7 million percent versus just 19,000% for the S&P 500. It's worked out like this because Warren Buffett is a great capital allocator, one of the greatest. He knows how and where to reinvest those retained earnings to earn high rates of return. And doing this, rather than distributing those earnings, has allowed the magic of compounding to work. Warren Buffett would say that if a company has the ability to reinvest its earnings back into its own operations in a way that would earn a good rate of return on that reinvested capital, then the shareholder would be better off with those earnings being retained and reinvested rather than distributed as dividends. And only once there was nowhere for that company to deploy that money in such a way that a decent return could be realized, then at that point, the money should be paid out to the shareholders as dividends. In such cases where a company has the ability to reinvest earnings at high rates of return, they would actually be doing the shareholder a disservice by instead distributing that money to them as a dividend instead of reinvesting it. In this case, as is the case with Berkshire, the shareholder would be better off if the company they own pays them zero in dividends and instead retains and reinvests all of those earnings, therefore allowing that money to compound. And for those investors who are actually needing an income to live off of, well, they could simply sell enough shares to provide them with the money they need in replacement of receiving dividends, and they would actually be better off this way. For some companies out there where the economics and opportunities available are such that there's nowhere worthwhile for the earnings to be reinvested sensibly, then dividends are the best option. And if that company were to attempt to reinvest but do so poorly and in such a way that a return was not realized, instead of paying dividends, well, that would be the biggest disservice to the shareholder because essentially they'd be just wasting the shareholder's money. For me personally, most of the stocks I own do not pay a dividend, and dividend yield is not an important priority for me at all. I'd much rather see a company that has a consistent track record of high returns on invested capital, and when I can see that a CEO is a good capital allocator like Buffett, then I'd much rather they just retain those earnings and put them to use themselves so that I can benefit from the compounding effect that will produce. If you like this video, please smash the like button for the YouTube algorithm and share this video with one person you think is going to benefit from it. And if you know someone that's obsessed with dividends, send this video to them. If you want to keep learning and keep that learning momentum going, then this next video for you right over here is the next one to check out. So click here, tap here, and I'll see you over there.